Hello, everyone. Welcome to our second Fundera Fireside Chat. This is a bi-weekly video series that we're going to be doing where we sit down with internal members of Fundera, external people that we work with to help kind of walk through and break down subjects that might be a little bit more complex but are really important to a small business owner's loan application, their financials in general. So be on the lookout for future videos. But today, I'm excited that we're going to be sitting down with one of Fundera's loan specialists, Manny Sevillano. Before we take it over to Manny, I'll tell you a little bit about myself. My name is Meredith Wood. I'm head of content here at Fundera, and I'm constantly creating and thinking of new ways to create an educational experience for our business owners that helps them be as successful as possible throughout their entire experience with Fundera, applying for a loan on our offer site, and in their business in general. So that being said, Manny, thank you so much for joining us today. And would you mind just telling us a little bit about yourself?
Yeah, sure, Meredith. So my name is Manny Sevillano. I am part of the customer success team here at Fundera, which is a phenomenal team. I specialize in the product and the loan process, helping both business owners and lenders in our network navigate our marketplace. Work closely with Meredith on a bunch of cool stuff like this as well. So looking forward to this.
Awesome. Well, again, I appreciate you taking the time. And so today's topic of conversation actually came about from a few conversations that you and I have had, Manny, and that's the topic of DSCR, or debt service coverage ratio, and really how important it is in the loan application, but how it can be used so differently depending on the lender. So I'd love to just jump right in, and I think it probably makes sense to get started with just sort of explaining what DSCR is.
Yeah, sure. So DSCR, or debt service coverage ratio, is a measure of a business's ability to pay their current debt obligations. So in short, it's the business's revenue after any kind of obligations or expenses. So typically what most lenders would consider EBITDA, and that's divided by your current debt obligations on an annual basis. It's usually a ratio that is measured against one. So if you are a business that debt service coverage ratio is above 1, it means that you're in positive grounds. If you're below 1, it means that you are probably unable to service your current debt obligations without having to borrow more funds. Ideally, the greater or higher the value above 1, the better.
Mm-hmm. So why does the number matter? Like, as a business owner, why should I care about this number?
Yeah, so I think there's two parts to that. I think internally for a business owner to be able to keep track of whether or not they're able to take on additional debt. If a business is looking to grow, has to finance specific projects or just normalize cash flow. This is kind of a good metric for a business owner to see whether or not they'd be able to take on more debt. From the perspective of a lender, it kind of just gives them that same exact idea, but for them, they're trying to manage risk on their end. So they definitely are going to want to lend to businesses that are going to be eligible and have the availability to service additional debt.
Great. And so we've had a lot of interesting conversations about how different lenders, especially if they have different types of products, are using DSCR throughout their process. So can you talk a little bit about how important it is during a loan application and maybe give a few examples of how different lenders would use it?
Sure thing. Yeah, I think that's a great question. And the reason being is that the debt service coverage ratio, of course, it's one of many data points that lenders in the industry are looking at. I definitely think it's one that's been around for a while. Banks, all kinds of lending institutions, and now the online lenders as well are deeming it, or at least finding a lot of value in utilizing this metric. But I think the best way to kind of explain this is to correlate or use the analogy that the debt service coverage ratio is more kind of like an efficiency metric. So the way that lenders are kind of looking at this differently, if you consider short-term debt lenders who are really focused on whether or not the business actually generates enough revenue to cover additional debt, may not be as in tune to the debt service coverage ratio because their debt is going to be paid back over a short period of time. So typically anywhere, let's say between 6 and 15 months. As long as the business is showing historical patterns of generating consistent revenue, most of these lenders feel comfortable. Now, if you are looking at lending institutions that are offering products that have longer maturities, then this is where this kind of really plays a big role. If a business shows that historically they've been able to service their debt, where their debt service coverage ratio has been in healthy levels, then it typically helps a lender that is looking to extend capital for longer than 1 year or 2 years. So they'll take a historical approach as well as, depending on how much capital they're looking to extend, they will then calculate the debt service coverage ratio with any future debt that will be on the books.
Great. And then, so for a business owner, even if like I'm in the process of applying for a loan, maybe I've applied for a loan, why do they need to be constantly tracking this number?
Yeah, it's an important number, to keep in mind for a business owner. If you're managing your business, and especially if you're kind of like in a growth phase, or you're looking to finance projects or certain things for the business, it's important because it helps you keep in mind what you are going to be able to service. As a business owner, it's kind of a daunting process to go out there and looking for financing, especially in an industry where all the information isn't there. And one of the great things that Fundera is doing is creating that transparency in the market. And things like this, Meredith, where we have these conversations, is definitely a helpful tool for us to share why debt service coverage ratio is important for business owners. So as a business owner, understanding, hey, I might need some capital in the future, or I might need capital now. I need to figure out what I can actually service as debt, and having an understanding of what your expenses are, what your available cash flow is versus what debt you're looking to incur is a really important metric. And I think that's healthy for any business owner to keep in mind. But at the same token, if you are looking for financing, it's a data point that the lenders are going to look at. So as long as this stays in healthy levels, that you're at least checking that off for the lenders.
Yeah. So something that is really interesting to me, just what we see happen here a lot at Fundera, is businesses come to us. They might be a little bit younger, the way that their cash flow is at the moment. They're eligible for shorter term loans, but they're very much interested in over time graduating into what we call internally medium term loans, which are essentially term loans 1-5 years in length that have monthly payments and just tend to be lower cost overall. And so for somebody that's really interested in sort of making that jump from a shorter term product into something like a medium term loan or even an SBA loan, what should their DSCR goals be?
Sure, I think that's a good question, and we see a lot of that here. So, the objective of someone who, in the current state, is only eligible for a short-term loan. The idea is that this debt is going to play a role in your current need, but ideally you're going to want to graduate into a better product. So when it comes to debt service coverage ratio, it definitely parlays into something else that lenders are looking for. And obviously you had a Fireside chat, the week past regarding profitability. So these multi-year lenders are going to want to make sure that there is enough available cash flow to service any additional debt. So a healthy place to be, of course, is above 1. But the further or higher away from 1 you are, the better. I would say a good metric, or I guess a good starting point, would be probably around a 1.15 or maybe a 1.2. Will kind of keep you in line with what most lenders are going to be looking for.
Great. And so the last question for you, and you've hinted at this a bit, but I'm sitting here, I've got a napkin and a pen. Can you just do like a quick, if I just want to very quickly calculate my DSCR, how I would do that?
Yeah, sure, absolutely. So I'll kind of take those numbers that I just said, the 1.15 and the 1.2. Let's use the 1.2. If you're a business that after you've or you're evaluating your earnings, after you've established your expenses and you've taken out a lot of the overhead that the business has, and you're essentially just looking at a number that's your cash available or your free cash flow. You'll take that number. Let's say in this case it's $120,000. And then you take what your current debt obligations are. And let's say that you owe on an annual basis $100,000. Back of the napkin, just take the 120,000 and divide it by the 100,000. You're left with a ratio of a 1.2. Great. So in this case, you're above 1. You're in good shape. If that number fell below, or if that ratio number fell below 1, then that's when you have to really revisit the amount of debt that you have and the amount of revenue that you're generating.
Awesome. Manny, this has been great. I always enjoy getting to chat through these sorts of topics with you. I just want to say to anyone who is watching that if ever you have questions for Manny or somebody that is in a similar position for Manny, feel free to give us a call just at 1-800-FUNDERA, or you can email support@fundera.com. We're here to help you walk through and understand those things that are a little more complicated. And sort of on the flip side, we do hope to do these fireside chats at least bi-weekly. So if you have ideas for things you'd like us to break down, let us know, because we'd love to know what topics you're interested in. But that being said, Manny, thank you so much for joining us today. I really appreciate it, and I know that business owners watching this will too. And that being said, we're signing off from our second Fundera Fireside Chat.
Thank you.